Hi everybody, welcome back to the channel. Today we're talking about GLD or gold. Specifically we're talking about the GLD ETF and how you can use this ETF to earn income from your portfolio. Now, we know that gold has been doing well since the end of last year. You can see here from the chart, specifically around December of last year, we saw this large run up, and this ETF is supposed to track the price of gold right here. So as you can see, we were trading at around 180 back in December of 2023. Going into 2024, that's when we saw the big jump up, specifically around March, trading around 190, going up to 243 on the ETF. And that brings us over to Fidelity. If you have a Fidelity account, this is one way you could do this strategy. But really what we're trying to do is target a strategy where we can earn some additional income from our ETF holdings, if we're holding GLD, that is. So, you can obviously hold the physical commodity in your hand. One of the benefits of doing this on an ETF like GLD, though, is that you can, in fact, earn income. And one thing that I talk about a lot on this channel is how to earn alternative income streams apart from, let's say, a 9-to-5 corporate job, right? So that's kind of the goal here on this channel. And if we talk about something else that came out, this was GLDI, and this came out in 2013, I believe, was when this first was released. Now, this one is actually tied kind of to GLD. It says it takes a long position in shares of the SPDR Gold Trust, ETF GLD, while selling call options. So it sells a covered call type strategy on the ETF. Now, one thing that I like to talk about a lot is called the wheel strategy, where we're taking cash secured puts and covered calls and doing them in rotation. And so this is specifically just for doing covered calls, and what they're trying to do is collect a net monthly premium, distribute that to shareholders in terms of cash flow, and then they're giving up any gains beyond the strike price, which is typical with covered calls, right? And that's one of the downsides to this strategy. But the thing with this strategy is that we're not just doing covered calls, like I said, we're doing cash secured puts and we're doing covered calls as well. So it provides no protection from losses, resulting in a decline in the value of GLD shares beyond the notional call premium received. And one thing to keep in mind is that this is not an ETF, this is an ETN. So this ETN also has pretty bad performance. Now, if we look at, over the long term, even though it's tied to the GLD ETF, over the last year since gold's been doing good, this one has gone up. However, over the last 5 years, it's down 15%. So keep that in mind. Since inception, and I believe it was 2013, they've done a reverse split on this thing. It's down 61%. Now, going back to GLD, though, the ETF itself, that one has done relatively well in terms of matching the price of gold. So this came out in 2004, actually, and you'll see how the performance of this one is much better than GLDI. So when we're dealing with an ETN like GLDI, even though it's following a covered call strategy against this ETF, keep in mind that the performance may not reflect that, because it's not really an ETF, it's an ETN, exchange traded note. It's also based upon Credit Suisse's credit profile, essentially. So if Credit Suisse goes under, then you could have that counterparty risk. So keep that in mind with GLDI. Same with GLD, right? It's an ETF. We all know that you can hold the physical commodity in your hand. The downside is you can't earn any income. If you do this on GLD, though, an ETF, you do this yourself, the wheel strategy, you can earn some income while also gaining exposure to the price of gold. So what we have here is selling to open, and you'll see here I have 3 contracts. The reason I did this is because I'm trying to target $100 per day. You'll notice the October 2nd expiration, the strike price of 243. And you'll notice the pricing here. This is on Monday evening, September 30th. So October 2nd would then be on Wednesday, right? So essentially what we're doing here is we're looking at this and saying, how can we make some income from our position without taking excessive risk? Well, if we're bullish on gold, we should have no problem being willing to buy this ETF at 243, because we're probably going to expect that the SPDR Gold shares are going to continue to increase in value. And as you've seen recently, 210, 220, 230, all the way up to 240. Some people are saying gold can go to 3,000. Would not surprise me at all. And if that happens, this ETF would follow suit, since it's designed to track the price of gold. So at 243, we're going to sell a cash secured put. Actually, we're selling 3 contracts, and what that means is we have to buy 300 shares of this ETF at the strike price of 243. And a good way to think about cash secured puts is that you're getting paid to buy stocks and / or ETFs such as GLD. So what that means is when I put this trade in, instead of paying my broker a commission, you're actually going to get paid for buying this ETF. And the only caveat is you have until October 2nd to buy this at 243, which means if this goes under 243 by October 2nd, then the buyer of the put option, since you're the seller of the put option, they can actually exercise the option, and then what happens is you will be forced to buy your 300 shares at the agreed upon price of 243. So then the buyer of the put option technically would win the trade. So it's kind of a zero-sum game with the buyer and seller of both call options and put options, because there's going to be a winner and loser depending upon what the price of the ETF is. But we're already comfortable buying this at 243. So instead of putting in a normal trade, right, to where we're going to just buy this on the open market, we're going to go ahead and do this cash secured put trade because it allows us to get paid. And regardless, we keep this $300 no matter what. And if you do the math on this, we're 2 days out. We're definitely doing over $100 per day. You can also look at the expirations on this, and you can see that we have October 4th, October 7th, October 9th, October 11th. So really every 2, 3, sometimes as you get further out, it'll be longer. Now we're at the weeklies, and then it goes into monthlies. But for these near-dated options, we have a lot to choose from. So I was making a video on SPY and QQQ and how you can do this on a daily basis with those ETFs. This is not quite on a daily basis, but it is every few days, let's say. Okay, so every few days you can do this strategy, which means if we're going to do this every few days, we want to collect more for each trade, right? So essentially every few days, let's try to target $100, right? So in that case, we're selling a cash secured put worth 300 shares times 243. If we do the math on that, 243 times 300 is going to be capital of $72,900 put up for this. So here's your max loss. That's where it comes in, right? Your max gain is going to be the premium. This would essentially be if this ETF went bankrupt. We know that gold's not going to go to zero. We also know that the assets are in good custody, we would hope, right? So that's one of the other things, right? Worst case scenario, GLD turns out to be a massive fraud, let's say, and the gold's not really there. This ETF's been around for 20 years, okay? So with that in mind, I seriously doubt you're going to be experiencing this max loss. I saw a comment, I think, in one of my videos saying I didn't discuss the max loss. And the max loss is really just a worst case scenario type thing, because most likely this ETF's not going anywhere, right? So this 243 to zero within a couple days from up until October 2nd, 99.999% chance of not happening, right? So the idea is let's collect this premium, let's buy the ETF at 243, and then worst case, we collect this $300 no matter what. Even if the ETF goes down to 235, let's say gold prices take a dip, the ETF goes down to 235, we still own 300 shares and we collected that $300. And now what we can do is turn around and sell a covered call. So let's say the ETF's back on the uptrend. Now we're going to go for the 244 strike. Since it's already at 243, we own 300 shares already, and we're selling a covered call. Kind of like I discussed with this GLDI, this is kind of the strategy that they're implementing with the covered calls and basically capping their upside, right? That's one of the downsides, because when you're selling a covered call, instead of agreeing to buy a stock at a specific, or an ETF at a specific price, you're agreeing to sell. So in this case, we're agreeing to sell 300 shares at 244. In exchange for this, we will collect this premium, the bid price of 76 currently. So 3 contracts, 300 shares. Our max gain in this case is 228 minus commissions 226. Max loss unlimited. Remember, we're selling a covered call. You don't have to worry about that. The way they calculate these max losses is, max gains. It's based upon a worst case scenario, right? So we already own the shares. We're not selling this naked. We're not selling this uncovered. This will be just fine, right? We're collecting 226. We have 300 shares we're selling up on this 244 strike. And that's same expiration, October 2nd. Now, in real life, obviously, the dates would change. You would move this back, and also the pricing would change on the ETF. But nonetheless, 226 within 2 days. That's still over $100 per day, because tonight is September 30th, tomorrow's October 1st, and then this expires on the following day, October 2nd. So all we need is this initial capital to put up. In this case, once again, we bought our shares at 243 times 300 shares, 72,000, and then we basically almost 73,000. And then what we do is we use that capital to collect these premiums on a consistent basis with these ETFs. And what I tell people is that you can also diversify between ETFs. You don't have to do this against a specific ETF like GLD. I'm also going to make one on SLV since silver's been doing good as well. But you can also do this against, SPY, QQQ. There's a bunch of them. And in general, when you're dealing with options and the wheel strategy, when you're selling covered calls and cash secured puts in rotation, there's a couple things to keep in mind, right? One is implied volatility, or how volatile is the asset relative to the overall market. Also, the liquidity of the ETF. So in this case, we have pretty good liquidity, I would say, in terms of the choices for calls and puts we can sell on the ETF. In terms of SPY or QQQ, you're going to have more liquidity, especially on SPY. I think that's probably like the most liquid in terms of being able to quickly enter and exit options trades with great pricing. I would say in terms of those premiums you can get for selling the options, there's definitely a lot of demand for those SPY options. But nonetheless, I mean, this can be a great strategy for anybody who's interested in earning some cash flow from their portfolios, whether you're a retirement investor or you're a younger investor and you want to try to start doing this more cash flow oriented type strategy instead of just focusing on growth and share price. This can be a great way to get started. So with that being said, let me know what you guys think in the comments down below. If you need additional resources or information on the wheel strategy, I will leave a link in the description. Check out dailyinvestmentadvice.com. Also, check out our sponsor, Seeking Alpha, in the description. They have a lot of tools and resources. I definitely recommend Seeking Alpha. They are a great website, great service if you're an investor looking for stocks and ETF ideas. But I'll leave these links in the description for you guys. Check it out. Thank you so much for tuning in. God bless, and we'll see you in the next one.